Hello and welcome to the second episode of Learn Along, where I go and research things that I come across during my stock speedruns that I wish I understood better. And I bring you along for the ride so that maybe we can both learn something. So, before we start, I did want to prattle on about one quick thing. If you've watched anything from me, you'd know that I enjoy using music from various video games as background music. And I don't just pick random stuff either. I like them to fit the video thematically. For example, the tracks I use for stock speedruns are all some kind of battling or racing music. So given the surprising amount of interest in the first Learn Along video, I feel like I needed to step up my music game for this series. For that first episode, I used the Wii Shop channel music because when people think video game background music, that's one of the first things that usually jump into their heads, and it's one of the first things that jumped into my head too, when only a few minutes before recording that, I realized I needed something. So now, though, I've collected some tracks from various video game classroom settings or tutorials, both of which I feel like fit the theme of these videos really well. So with all that said, the track that you're going to hear playing for this video is the Trainer School theme from Pokemon Sun and Moon, and that's what I wanted to prattle on about. So as for this video, we are going to be researching what exactly is GAAP, which stands for, I believe, Generally Accepted Accounting Principles. Watch me be wrong once I hit enter here. No, I was right. Okay. Generally Accepted Accounting Principles. And one of the reasons why I'm really interested in knowing what GAAP is, and you know, one of the things that I really want to know that's going to be probably hard to find is not just what is GAAP, but rather why GAAP exists. Why does there need to be a special way of calculating what your earnings are? Like, who decided that certain things don't count into that number? I'm not sure. Let's go ahead and look through this. Let's see. Refer to a common set of accounting principles. Hey, you don't say. Public companies in the U.S. must follow GAAP when their accountants compile their financial statements. I guess it's law that they have to use these principles. Set forth by the FASB. I'm not too sure what that is. What is FASB? Financial Accounting Standards Board. Interesting. Aims to improve the clarity, consistency, and comparability of the communication of financial information. Actually, you know what? As for the why of GAAP, this kind of makes sense. Because to have, let's say this company reports these numbers and this company reports those numbers, right? If they're not all calculating their numbers the same way, if they're not all deciding, you know, what is expenditures or what is revenues, then I can see it be possible that, you know, the numbers are off as far as their comparability goes. So you know what? As far as the why, this makes sense. I still do want to know the why as to why certain things are included in certain categories and not others. That's something I still want to know. But as far as the why of why even do this, this actually kind of makes sense. Maybe contrast with pro forma accounting. Ooh, is that going to need to be a follow-up? I kind of want to know what that is. Which is a non-GAAP financial reporting method. Actually, you know, with looking up GAAP, I wanted to know what non-GAAP was too. Because you see that mentioned sometimes also. The ultimate goal of GAAP is to ensure a company's financial statements are complete and comparable. Yeah, you said that already. 10 key principles. Let's see. Understanding GAAP. Combination of authoritative standards. Contrast with pro forma. Helps govern the world of accounting according to general rules and guidelines. There's 10 principles that lay out the main mission of the generally accepted accounting principles layout. 1. Principle of regularity. The account has adhered to GAAP rules and regulations as a standard. And principle of consistency. Accountants commit... Alright, you know what? I'm not reading this whole paragraph. Principle of sincerity. The accountant strives to provide an accurate and impartial depiction of a company's financial situation. Principle of... Should I do this voice for each one of these? It's actually kind of starting to... I thought it'd be fun, but now it's kind of starting to be annoying. No. We have principles of permanence of methods, principles of non... Okay, wait. I should probably read what these are. Principle of permanence of methods used in financial reporting should be consistent, allowing a comparison of the company's financial information. Yes, that makes sense. Actually, come to think of it, with comparability, it's not just comparing company A to company B. It's comparing company A's earnings from quarter to quarter. Because if this didn't exist and they wanted to make themselves look better the following quarter, they could fudge the numbers. You know, let's count this as that and that is this, and then the numbers will look better. So it's not just consistency across companies; it's consistency within the same company. Also, that makes a lot of sense. Principle of non-compensation. Both negatives and positives should be reported with full transparency and without the expectation of debt compensation. I'm not too sure what this is talking about. Both negatives and positives should be reported with full transparency and without the expectation of debt compensation. I'm not sure what debt compensation is. Debt compensation. Sometime today would be nice, Google. Doing deferred compensation and pensions is a payoff structure resembling that of outside debt. Inside debt, including deferred compensation and pensions. That might be a topic for another video, because this seems like something else that's complicated to dive into. I'm going to make a note of that later. Okay, principle of prudence refers to emphasizing fact-based financial data. Yes, I'm back to doing the voice. Fact-based financial data representation that is not clouded by speculation. Principle of continuity. While valuing assets, it should be assumed the business will continue to operate. Why do you need this? Be assumed... I mean, I guess that makes sense. Because if this wasn't here, you could make the assumption that the business is going to close up shop tomorrow and end all, and that would probably make their assets less valuable. That's just a guess, though. Principle of what the hell is even that word? Periodicity? Is that how you say that? Periodicity. Entries should be distributed across the appropriate periods of time. For example, revenue should be reported in its relevant accounting period. I mean, that just makes sense. Principle of materiality. Accountants must strive to fully disclose all financial data and accounting information in financial reports. No hiding anything, you sneaky accountants. And also 10, principle of utmost faith, derived from the Latin phrase uberrime fide. Used within the insurance industry, it presupposes that parties remain honest in all transactions, which sometimes doesn't turn out to be true. There's been cases of people, just outright lying on their financial reports. I mean, they get caught eventually, but sometimes you gotta what's the word? What's the phrase I'm thinking of? Something trust? I don't know. But yeah, you just gotta trust what they say, and hope that if they're lying, it'll be uncovered eventually. Compliance with GAAP. Yes. So what does compliance entail? If it's publicly traded, then it has to do this. Its financial statements must adhere to the rules established by the U.S. Securities and Exchange Commission. If it's not publicly traded, then I guess they don't have to do this. Requires publicly traded companies in the U.S. regularly file GAAP-compliant financial statements. Quarterly they do. Is ensured through an appropriate auditor's opinion. Should I delve into what an auditor's opinion is? Maybe. I'm going to let that load. Resulting from an external audit by a certified public accounting firm. Although it is not required, yes, here. So, although it is not required for non-publicly traded companies, GAAP is still viewed as favored by lenders and creditors. That makes sense. There's enough. I feel like there's enough public pressure because if you're a non-publicly traded company, you don't have to report GAAP. But I feel like if you start not reporting GAAP, if you start reporting non-GAAP, people are gonna look at you funny. People are going to look at you like, what are you trying to hide here? Why are you doing it this way? So it kind of makes sense that it's still a preferred favorable method. Will require annual GAAP compliant financial statements, part of their debt covenants when issuing business loans. Is not prepared using GAAP. Investors should be cautious. Yes, just like I said before. That's why. Even if they don't have to, they probably still use GAAP if they're non-publicly traded, because if you don't, then that can bring up some red flags for a lot of people, I would assume. Without GAAP, comparing financial statements of different companies would be extremely difficult, even within the same industry, making apples to comparisons hard. That makes sense. Some companies report both GAAP and non-GAAP. I have actually seen that, both GAAP and non-GAAP. I think most do, actually. I think most earning reports you read, you will see mentions of GAAP and non-GAAP. At least that's been my experience. Maybe I'm just over-representing the portion that do non-GAAP, because that's the ones that stick out in my head. GAAP requirements by state. I'm not too sure what this means. I mean, by state. I thought this was federal law. I don't know what this chart is supposed to... Oh, shit, I can zoom in. I don't know what this chart is supposed to mean. It said it's at the federal level. So why is it showing me these things by these things? GAAP requirements by state. I want to know more about what this is talking about. All 50 state governments prepare their financial reports according to GAAP. So even the state governments prepare their own financial reports according to this principle. Is that what this means? But then if that's what this means, then this chart, this diagram, is at odds with this. Because if that's what this means, then states like, Washington and Idaho and North Dakota and Indiana and Illinois are not reporting their financial statements in GAAP when it said right here, all 50 state governments prepare them in GAAP. Are all districts prepare their financial reports in GAAP? Estimates that about half of the states officially require local and county governments to adhere to GAAP. I guess that's what this means? Is that this is a chart of whether or not the states require the... What was it again? Require the local and county governments to adhere to it. I kind of wonder what the somewhat and the mostly mean. Did they just point out certain counties that have to? Certain towns that have to? That's a little strange. Here's the principles again. No, I wanted to see about the state. State. Half of the states, according to... And with legislation like the Securities Act of 1933, Securities Exchange Act of 1934, so it dates back to the 1930s. It makes sense that something like this would come about shortly after the stock market crash. Everyone, lost their minds about money after that. All 50 state governments prepare their financial reports. I guess that's what that means. Who came up with it? Hey, let's learn some history here, sure. Federal government requires public companies, blah, 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 blah. Oh, you're not gonna like give me a name or anything? Okay. Very interesting. Financial reporting, framework, hierarchy is broken down as follows. Statements by the FASB board. Use it consists of a framework for selecting the principles that account as... Oh, this is how they decide the rules. I don't really care about that. I just want to know what the rules are. Because I've looked at this before. I think I did. And I didn't quite understand why certain things were counted and certain things weren't. So, let's see. What is IFRS? Focused on the accounting and financial reporting of U.S. companies. The international alternative to GAAP is the International Financial Reporting Standards. So why do they differ? Some differences that exist between both rules include LIFO inventory. While GAAP allows companies to use the last in, first out as an inventory cost method, it is prohibited under IFRS. What is last in, first out accounting method? It's a method used to account for inventory that records the most recently produced items as sold first. I'm trying to wonder why that matters. A cost of the most recent products purchased or produced are the first to be expensed as cost of goods sold, which means the lower cost of older products will be reported as inventory. That doesn't make... That doesn't... I actually kind of... So, if I understand this right, I kind of agree with IFRS that this should be prohibited. Because you can easily fudge numbers with this. Or rather, not fudge numbers, but it encourages you to... Okay, so let's say you have... You know what? I'm gonna bring up the drawing pad for this. So here's some inventory, right? Let's say it cost $1 million to produce this. So it's arguably valued at $1 million, right? That's what it means. Lower will be reported as inventory. Now let's say that you produce some new stuff. It's reported as $2 million, right? Now, the method used for accounting that records that most recently purchased items as sold first. Now, well, that depends, because okay? Here's a question I can't answer. Is it better to have more value in inventory on the books? If yes, then you are encouraged to move this older inventory of cheaper, potentially not as good products first. But if it's cool to have less on the books, then you want to move the newer stuff first. And in that case, the older stuff sits around perhaps even longer than it really should be. And if it sits around long enough, you probably can't ever sell it. You think Apple can unload any iPhone 2s that might be sitting in storage somewhere nowadays? No. What are the implications of this for any given company? I don't friggin' know. I just wanted to draw pretty pictures. Okay. Although I kind of... This doesn't really make a whole... Still, this doesn't make a whole lot of sense to me. You should need to report what the actual... Like, if the company had an incentive to move this first or an incentive to move this first, I don't think the way that it accounts for numbers should have to play into that. It should have to, move what it moves, you know, if it produced this and then this, but it moves this first, then it should be able to report, 1 million inventory. I don't see why not. That seems crazy. Maybe, okay. Literally the only reason that I can see for this being the case is that if you had to track inventory as it's moved, then it is a lot more overhead for tracking what's where. Because if you just had a pipeline of numbers, which is basically what this is, then that makes it easy. But if you have to track every little piece, let's say these are your product, these lines that's sold, and when they were produced, how much they were produced for, that's a lot of overhead. So you know what? I'm not entirely sure. It still sounds kind of dumb to me, but I can see the reason for it. Okay, research and development costs. These costs are to be charged to expense as they are incurred under GAAP. Under IFRS, the costs can be capitalized and amortized over multiple periods if certain conditions are met. Be charged to expense as they are incurred. With this one, I'm gonna go ahead and side with GAAP on this one. I think it makes sense to incur the costs when they actually happen, as opposed to spreading them out over a certain period. That just seems kind of... Although, I kind of wonder if this is the opposite of the LIFO inventory case, where having to report it when it's actually done, that's a good amount of overhead tracking expenses. If you were just able to say at the end of a period, or over a certain period, hey, we spent this much money. We don't know exactly when, but we know it was from here to here. Then, that's less overhead. So I wonder if that's why this was done this way also. And then reversing write-downs. The hell is that? Specifies that the amount of write-down of an inventory or fixed asset cannot be reversed if the market value of the asset subsequently increases. The write-down can be reversed under IFRS. What is write-down? For this reduction in the book value of an asset when its fair market value has fallen below the carrying book value. Write-down of an inventory or fixed asset cannot be reversed if the market value of the asset subsequently increases. Why? That's friggin' dumb. If you're that's okay, here. Let me erase this. Wait, hold on a second. Okay, new sheet. So if I'm reading this right, what that means is that if you have inventory and it decreases value over time, let's say this is the book value, right? It decreases value over time. If it do I bring book value into this? Its fair market value has... Alright, you know what? Never mind. Forget the book value line. This is decrease over time. This is natural decrease over time of value reduction. If suddenly, something happened, like think of masks, right? Over COVID, think of masks. Nobody was ever thinking about masks, right? So let's say you run a mask company and this is your inventory. You produced way too many masks and you don't know what to do with all of these masks, right? And then all of a sudden COVID happens, masks go through the roof. Here's the roof, it's getting busted open. You apparently can still only, you can't, on your balance sheets, you can't account for this increase. It has to sit here, right? The amount of write-down of an inventory or fixed asset cannot be reversed if the market value of the asset subsequently increases. You can't do it. It's always at its lowest point on your books. Now, is that good or bad for the books? I don't know. I'm not an accountant, but that seems kind of messed up. Because numbers should represent what they actually are. This rule, again, seems kind of arbitrary, but I wonder if it's here to cut down on overhead. Okay. Corporations increasingly need to navigate global markets. Almost all S&P 500 report at least one non-GAAP measure of earnings as of... Yeah, I thought so. I thought I saw a GAAP and non-GAAP for most companies. Their principles. Why is GAAP important? We already went over that. What are GAAP measures? What is... So you know what? You know what this didn't go into that I was hoping for? What are the actual GAAP rules? It explained the difference in the GAAP rules between this and IFRS. I want to know what the actual rules are. What are GAAP rules? I don't know. If I was to open any of these, it would just be a crapshoot. Probably close these. I think I'm done with those. See, what are these pictures? Actually, Wikipedia might be able to tell. No, this is the same website as before. Oh. Let's see what Wikipedia has to say. Merely a set of standards. Yeah, I want to know what those standards are. Can you give me like a list or something? I'm interested in reading them. Here's the principles again. Yep. All the development for issuances from. All right. You know what? You know, it's probably not. I probably can't find it on some Joe Schmo website because it's probably very long, probably very boring, probably a lot of nerdy accounting stuff in there that most people don't care about. So maybe I don't need to see literally all the rules, but it would be nice to know what the rules are. But you know what? It's not terribly important. Because regardless of what the rules are, everyone has to use them. That's the important part, again. Remember, comparability. I like that it enforces comparability. So, I think we're good to end here. I think we now have a fairly good idea of what generally accepted accounting principles are and why they exist. They are federally enforced, it seems like. And they exist so that everybody reports their numbers the same. Because if they didn't, then you would have all kinds of chaos going on, a lot of, book cooking happening between companies, trying to make themselves look better or worse than they actually are. So yeah, I think I think we have a fairly reasonable understanding of what GAAP is now. I do. I hope you do too. And thank you so much for joining me.